So now in segment three, we're gonna really carry from what we were talking about in segment two and look at personal income, look at how that consumption has shifted and where it's going to continue to shift into. So personal income was softer in August, coming in at 0.2% versus the estimate of 0.2%. But it was 1.1% in the prior month. So you're seeing, again, coming down, you're just seeing that personal income. And we'll look at it when you include transfers, take away transfers, but also what does that mean when you factor in inflation? You know, inflation is making your dollar worth less. And that's where we're seeing that start to come through. With spending still was at 0.8% versus the estimate of 0.7% and was negative 0.1% in the prior month, which was revised down from 0.3%. So that revision down kind of helps the month over month number, but it gives you an idea that in August you also had, and we talked about this at the end of last month, is you had a fairly strong back to school spend and just kind of bringing it back to what we were talking about. A lot of those unemployment benefits have now gone away. You're starting to see that come through and the residual is gone. So you're seeing a big step down in spending, which is going to continue through Q4. Now, personal income, excluding transfer receipts, changed to $2012. Real personal income, excluding government transfer payments, has not officially reached pre-pandemic peak and actually ticked down in August. So again, when you take away the government transfers from this past month, you still are at a negative growth on the income side. So again, we're not, even though we keep hearing about these wages, and that's why we talk about it in quartiles, because you're just only seeing it at the lowest, but you're seeing this pressure at the top, and this is only going to increase a lot of that pressure. And what happens because of that? Well, personal savings rate came down in August to 9.4%, slightly off recent bottom of 9% in June, but still above. So you still have that savings, but as we've seen in September, as we saw with people who had and didn't have unemployment benefits, you're starting to see that move back down, and that disposable income, that personal savings, is really starting to drain down. And the reason why is government transfers still account for 20% of personal income. It's way off of the all-time highs, but you're going to continue to see that whittle down as some of the remaining programs expire. So then when you look at personal income versus personal consumption, both personal spending and income have both moved closer to their pre-pandemic trend lines. Because when you look at trend lines, typically when you look at consumption, this yellow line, consumption is based on value. This is looking at it in nominal dollars. So the value of things has gone up. So the fact that we're still here, but personal income is come back down and now starting to continue to go sideways and really not going back up, which is where you're getting this diverge between cost of goods and wages, where personal income is just not keeping up on the inflation, especially as prices continue to get passed through and they continue to go higher. So then when we look at that rotation that we've been talking about and we talked about in segment two, when you look at it, so personal income was up that 0.2%, compensation and child tax credit was higher, so that child tax credit pushed things up. Unemployment benefits were lower. Consumer spending, real spend was about 0.4%, and that savings piece, but inflation sticky prices were up 0.4%, inflation at about 4.3%. So that rotation is when you look at durable goods continues to shrink, services is getting closer and closer to pre-pandemic levels, but you're starting to see again that narrowing where services are getting almost back to pre-pandemic as we continue to see the good side of things, especially on the durable goods, continuing to push back down. Now, non-durable goods bounce back up, but you also had a certain amount of back to school that's mixed into that. So now looking at it a little bit differently, when you take U.S. consumer spending change from February through July 2021, you can see that convergence is going to continue with the next leg really being driven by services. Now, when you look at the inflation side, though, and this is what we like to talk about, when you look at inflation at 4.3% year over year, up 0.4% month over month, you still have this next leg up when we start, and we'll talk about rents again, we'll talk about housing again, that is going to continue to be that driving force that is not only going to cap, again, your wages, because you're going to have more going towards rent, but not only just rent, you have, clothes going up in price, you have toys, you have everything that you consume on a daily basis that is up anywhere from 5 to 15%, depending on where you live, what you're buying, what we're talking about. I mean, some of this stuff is up over 20%. And that is, again, going to keep us very well bid at the top end, or I should say top and to the right of that graph. But then when you look at the contraction in goods spending is likely, over the coming year. And it's because it takes time. Like, you had a lot of government transfers, you had a lot of money coming through. So you're going to continuously see that, again, creep back down. But when you look at what could happen, what could that draw down? And the view is that that could create a negative 10% year over year contraction. Now, that won't happen to that level because you have corporations, you have inventories that have to rebuild. So even though the consumer is going to continue to slow, you're going to have that offset to a degree of inventories getting rebuilt and helping to soften some of this blow. But that's why when we look at the fiscal drag that was created from so much stimulus, this is what we're talking about when you look at that consumer that essentially pulled forward a significant amount of spending. And as it comes back to the trend line, that's where you're going to see, and that's why we talk about manufacturing goods, why we talk about raw materials, why we talk about the inherent supply chain that's going to continue to have this overhang. So then when you look at personal consumption expenditures continuing to trend higher, and a lot of this is really driven by just the inherent cost that has gone up as companies continue to try to push through as much price as possible, but we're starting to see consumers balk at pricing as we discussed in segment 2. Which is why when you look at sentiment, expectations, present conditions, they're still at the lows. Now, they've bounced a bit off the lows, but they are still seeing a lot of pressure because the consumer is seeing this elevated issue. They're seeing these elevated issues. They're seeing the problems in general. And again, that's keeping them a little bit closer to the vest. There's a lot of concern on where things are going to go over the foreseeable future. And that's when you start looking at U.S. consumer-based inflation expectations are going higher again, given based on gasoline is back to a high. You have diesel exploding another 7 cents at $3.47 nationally. You have natural gas going up. You have all of these things that people are looking at and see. And then that doesn't include going to the grocery store and seeing the bill being $100 more than normal. There is a lot of pressure that is keeping these inflation expectations bid. And this is where you're seeing it move further and further away from the trend line, which is why, shockingly, you're starting to see some of these comments from the Fed, from central banks, that they have to start doing things to abate some of this inflationary pressure. But with the end of unemployment, with the end of a lot of these pieces, you're starting to see a increase in job seeking and recruiting searches throughout September. And now when we look at ADP numbers came in slightly better than expected, came in about 540,000. Expectation was for about 300. As we said last month, we expected September to be strong. So that's where, so to see September kind of pick back up, this is just confirming what we've already seen. And it means that, and based on this, we should see some of that continuation through October. But are you offering your employees an option to permanently work from home? Yes, on a full-time basis was 23%. Yes, on a part-time basis was 20%. Yes, on either a full-time or part-time basis. So based on that, you're talking about 45, you're talking about almost 67% is 68% is saying that they're offering some form of work from home flexible schedule. Again, this is a huge shift in the way we see consumption, the way we see just people generally moving about and spending and utilizing gasoline and other. This is where we see some of these shifts overall. So then when you look at remote work has increased businesses' willingness to use freelancers, another shift where companies are like, well, I can hire someone who's going to be a W-2. That's an increase in taxes. That for me, that's an increase in benefits. Or I can 1099 a freelancer, which then allows me to offload some of those additional costs, which is something that we've seen corporations do at a greater pace. So then when you take all of that in and look at manufacturing orders, so August factory orders were stronger, came in at 1.2% versus 1% estimate, and it was versus last month of 0.7%. So you're seeing some of that move higher. Then when you look at where things are, the manufactured orders are still elevated, and then excluding transportation, still driving higher. It's just as you look at PMIs, as you look at credit impulses, this is starting to roll over a bit, or at least it should. The problem is the backlog is so large, and there's such a shortfall in inventories. This is going to stay elevated longer than in historics, longer than it should, because there has to be a bit of that rebuild, if you will, as to the inventories that are missing. But what does that mean going forward? And as we talked about in segment 1, the U.S. non-financial corporate debt due to mature each year is only getting worse. So now you're seeing an elevated amount. This is something that is playing out across the world. And as rates go up, it's going to get more and more expensive to roll this debt and to carry the interest, which is going to weigh on investment, which is going to weigh on CapEx, and is going to become a bit of an impediment to where that future growth is going to be on a GDP level. And the debt share by product type and age, you can see that just the mortgages continue to be that overhang. So the fact that people were able to get mortgages at a lower rate means that there's been a lot of opportunity to kind of offload some of this excess. Now, this is going to be something that will carry through the remainder of the life of the mortgage, but the problem comes with the value of the home goes up, and not only do you get a mortgage, but you get a equity line. And that equity line is where you kind of make or break what that situation is going to look like, as we learned in 07 and 08, which will be that overhang, because equity values have exploded. So that's something that we have to look at and consider as housing prices start to come back down to earth. So then when we shift that and say, well, the change in private capital equipment prices from a year earlier. So when you look at the equipment that's being purchased, so you have companies that have to worry about debt, which means that they're going to try to hire a bit less, maybe replace things with equipment. Well, it's driving up the price of equipment. So now you're getting inflation in a completely different place, which is also being a huge overhang for where things are going to be in the future. But when you look at mortgages, and one of the things when you look at kind of how this balances out with corporations and where things are going, well, the biggest increase in mortgage issuance was in the 40 to 49-year-old backstop. And then you had some expansion 30 to 39, but it was really that 40 to 40, or I should say 40 to 59, that was really that lion's share, which is why you had a lot of people that had credit scores over 760. You had some additional cash that was being put down. The question is now, who is the next incremental buyer, and what is going to be the quality of that person getting that loan? Which is when you start looking at the median age of U.S. home buyers is up from 31 to 47. Again, seeing that get pulled higher because it's harder and harder to get the amount of money necessary to have a down payment to actually purchase that home. So then when you take that and look at the impact of real estate related activities on GDP, this is where you start to look at what that overhang could be. You know, the U.S. right now is about 17%. As that starts to roll over, we've already seen it in Korea. We've seen it in Germany. China is the one that I want to call attention to because we're going to talk about it again in segment 5. But China has the real estate related activities is almost 30%. It's about 27% of GDP, which again is more than double what it is in the US, which it just increases the chance of a much bigger fallout as we continue to see Evergrande, Fantasia, and these other issues play out. But house prices to boost inflation. So as these home prices come up, we have yet to even see this start to get baked into the CPI owner's equivalent as well as CPI primary rents, which again is why when we look at inflation, when we look at the driving force overall, we continue to see this grinding higher. And then when you look at buying conditions, so when you look at buying conditions for a vehicle, it's the worst ever. When you look at buying conditions for a car, it's the worst since, essentially the worst since, what is that, outside of the beginning of the year. I'm sorry, total sales. So the buying conditions for a vehicle, worst ever, and then total annualized sales are back to where they were at in about 2010. So you're looking at essentially people saying, if I don't need to buy a car, I am not buying a car, because it's such an the worst time ever. Auto sales continuing to plunge to recessionary levels at 12.2 million annualized as of September. So then when you take all of this, construction spending flatlined in August, 0% versus 0.3% estimate. And again, you're just seeing this slowdown where people are struggling with equipment. They're struggling with the lack of materials, the cost of materials. So construction is starting to slow, and they're waiting for some normalization coming back into the market. So now that we talked about a lot of this, we want to look at what's happening in Europe, what is happening with this electricity crisis, and what are some of the things that we expect to happen over the next few months, especially when you factor in how this is going to impact the consumer as well as inflation.